Auditing cash accounts involves verifying the accuracy and existence of cash that a company reports in its financial statements. As the most liquid asset, cash is susceptible to misstatement and fraud, making its audit crucial for the accuracy of financial reporting. The process includes examining the cash balances as stated in balance sheets, ensuring they align with the bank statements, and validating internal controls that safeguard cash. The importance of cash audits cannot be overstated. Cash transactions occur frequently and are often substantial, impacting a company's liquidity and financial health. Auditors must ensure that these transactions are recorded accurately and that cash is protected from unauthorized access or manipulation. This requires a careful review of all cash-related activities such as deposits, withdrawals, transfers, and reconciliations. Moreover, auditing cash involves examining the company's internal controls over cash handling and recording. Auditors assess whether these controls are adequate to prevent errors or fraud. This includes evaluating procedures for cash receipts and disbursements, as well as reconciliations of bank accounts with company records. Finally, the auditor's role extends beyond verification to providing insights into the effectiveness of a company's cash management processes. By identifying areas of improvement, auditors can help organizations strengthen their financial operations and reduce the risk of financial misstatements. In the realm of auditing, significant accounts related to cash encompass various elements that are crucial to ensuring accurate financial reporting. The primary accounts include cash on hand, cash in bank, and cash equivalents. These accounts collectively represent the total cash resources available to the organization and must be disclosed accurately in financial statements. Cash on hand refers to physical currency and coins that the company holds in its premises. This account is typically used for daily operational needs and petty cash transactions. Its accuracy is verified through physical counts and reconciliations with recorded amounts, ensuring no discrepancies exist between what is reported and what is present physically. Cash in bank involves funds deposited with financial institutions, including checking and savings accounts. It is crucial to reconcile these balances with bank statements to detect any discrepancies or unauthorized transactions. This process involves cross-verifying the company's ledger with the bank's records and ensuring that all transactions are accounted for. Cash equivalents comprise short-term, highly liquid investments that are readily convertible to known amounts of cash. These may include treasury bills, money market funds, and commercial paper. Disclosures regarding the nature, terms, and risks associated with these instruments are essential to provide transparency for stakeholders. In summary, auditors must ensure that all cash-related accounts are accurately presented and disclosed. This involves thorough verification procedures and an understanding of the company's cash management policies. Such diligence helps maintain trust and reliability in financial reporting. Inherent risks in auditing cash accounts are those risks of material misstatements that exist due to the nature of cash itself. Cash is inherently risky because it is easily transferable, universally accepted, and highly liquid, making it a prime target for misstatement and fraud. Without effective controls, cash is particularly vulnerable to errors and theft. One significant inherent risk involves the misstatement of cash balances due to human error or administrative oversight. For instance, errors may occur during the recording of cash transactions, such as deposits, withdrawals, or transfers, leading to inaccurate financial records. These errors can be compounded by the high volume and frequency of cash transactions, making detection challenging. Another inherent risk is the misclassification of cash and cash equivalents. Companies may incorrectly classify non-cash items as cash equivalents, thus overstating their liquidity and misleading stakeholders about their financial position. This misclassification can arise from a lack of understanding of what constitutes cash equivalents or inadequate accounting expertise. Fraud is also a significant concern, with fraudulent activities such as embezzlement or falsification of cash records posing a constant threat. Employees with access to cash may manipulate records or steal funds without immediate detection if stringent controls are not in place. This risk necessitates robust internal controls and regular audits to safeguard against such occurrences. In conclusion, understanding inherent risks in cash accounts is vital for auditors to devise effective audit strategies. By recognizing these risks, auditors can implement tailored approaches that address specific vulnerabilities, ensuring accurate and reliable financial reporting. Fraud risks in cash accounts involve intentional misstatements or omissions of cash-related information to deceive stakeholders. Auditors must be vigilant in detecting such risks, as they have the potential to significantly impact an organization's financial integrity. Fraudulent activities related to cash can take many forms, each with its unique challenges for detection. One common fraud risk is skimming, where cash is stolen before it is recorded in the books. This type of fraud is particularly insidious because it does not leave an audit trail, making detection difficult without thorough scrutiny of cash handling procedures. Auditors must examine discrepancies between actual cash receipts and recorded amounts to uncover such schemes. Another fraud risk involves lapping, which occurs when an employee conceals a cash shortage by delaying the recording of cash receipts from customers. This creates a cycle of misstatements that can continue unnoticed unless detected through comprehensive reconciliation processes. Auditors must conduct surprise cash counts and verify customer payments to identify such irregularities. The manipulation of bank reconciliations is also a potential fraud risk. Employees may alter reconciliation statements to cover up unauthorized withdrawals or adjust balances to hide cash shortages. This can be addressed by independently verifying bank statements and ensuring that reconciliations are performed regularly and reviewed by different personnel. Ultimately, understanding fraud risks is essential for auditors in identifying and mitigating potential threats to financial accuracy. By employing rigorous audit procedures and maintaining a skeptical mindset, auditors can effectively address and reduce the likelihood of fraud in cash accounts. Section 5. Control risks. Assessing control risks related to cash accounts. Control risks in cash accounts relate to the potential for internal controls to fail in preventing or detecting errors and fraud. These risks arise from weaknesses in the systems and procedures designed to safeguard cash and ensure accurate financial reporting. Auditors must assess these control risks to determine the effectiveness of an organization's internal control environment. One critical control risk involves insufficient segregation of duties. When a single employee is responsible for handling cash receipts and recording transactions, the opportunity for misappropriation increases. Auditors should evaluate whether duties are appropriately divided among different individuals to reduce the risk of fraud and error. Another control risk is the lack of regular cash reconciliations. Without timely reconciliations of cash accounts with bank statements, discrepancies may go unnoticed, leading to inaccurate financial records. Auditors must assess whether reconciliations are performed regularly and whether they are reviewed by independent personnel to ensure their accuracy. Ineffective management oversight also poses a control risk. If management does not actively monitor cash activities or review financial statements, there is a higher likelihood of errors and fraudulent activities going undetected. Auditors should evaluate the level of management involvement in cash management processes and their commitment to enforcing internal controls. Lastly, inadequate documentation and record-keeping can compromise the integrity of cash account records. Auditors should ensure that all cash transactions are properly documented and that supporting evidence is retained for audit purposes. This includes verifying that procedures exist for maintaining records and that they are consistently followed. In summary, control risks in cash accounts highlight the necessity for robust internal controls. By assessing these risks, auditors can identify areas for improvement and recommend enhancements to strengthen the organization's control environment. Section 6. Analytical Procedures. Preliminary analytical procedures for cash. Preliminary analytical procedures are essential in auditing cash accounts as they provide auditors with an overview of the organization's cash-related activities. These procedures involve the use of financial data analysis to identify unusual trends, fluctuations, or relationships that may indicate potential misstatements or fraud. One common analytical procedure is the trend analysis of cash balances over time. By comparing cash balances from different periods, auditors can identify abnormal increases or decreases that may warrant further investigation. Sudden changes in cash levels could indicate issues such as unrecorded transactions or unauthorized disbursements. Another procedure involves the analysis of cash flow ratios, such as the current ratio or quick ratio. These ratios provide insights into the organization's liquidity and ability to meet short-term obligations. Significant deviations from industry norms or historical trends may signal cash management issues or financial distress. Auditors also compare recorded cash transactions with bank statements to ensure consistency. This reconciliation helps identify discrepancies between company records and actual bank transactions, which could point to errors or fraudulent activities. Auditors must ensure that all cash receipts and disbursements are accurately reflected in the financial statements. Lastly, auditors may perform reasonableness tests on cash transactions. This involves evaluating whether cash flows align with expectations based on the organization's operations and industry conditions. Unreasonable cash flows could indicate misstatements or fraud, prompting further investigation. Through these preliminary analytical procedures, auditors gain a comprehensive understanding of the organization's cash position and identify areas that require detailed examination. This proactive approach aids in detecting potential issues early in the audit process. Section 7. Response to risks, determining appropriate responses. In response to identified risks in auditing cash accounts, auditors develop strategies to address these concerns effectively. These strategies are designed to mitigate the risks of material misstatements and fraud, ensuring the accuracy and reliability of the financial statements. One key response involves enhancing audit procedures for areas with identified risks. For instance, if there is a high risk of fraud, auditors may increase the frequency and depth of cash counts and reconciliations. This ensures that discrepancies are detected promptly and addressed before they impact financial reporting. Another response is to increase skepticism and scrutiny during the audit process. Auditors may apply more rigorous testing methods and seek additional corroborative evidence to support the existence and valuation of cash balances. This helps ensure that all cash-related transactions are valid and accurately recorded. Auditors may also recommend improvements to internal controls as a proactive measure. By identifying weaknesses in the control environment, auditors can suggest enhancements that reduce the likelihood of future errors or fraud. This may involve recommending changes to cash handling procedures, segregation of duties, or management oversight practices. Finally, communication with management and those charged with governance is crucial in addressing identified risks. Auditors should discuss their findings and recommendations with management to ensure that corrective actions are implemented promptly. This collaborative approach helps organizations strengthen their control environment and improve financial reporting practices. In summary, responding to risks in cash audits involves a combination of enhanced audit procedures, increased skepticism, control improvements, and effective communication. These strategies collectively contribute to the accuracy and integrity of financial statements. Section 8. Tests of controls suggesting and analyzing results. Tests of controls in auditing cash accounts are designed to assess the effectiveness of an organization's internal control systems. By performing these tests, auditors can determine whether controls are functioning as intended and whether they are adequate in preventing or detecting errors and fraud. One common test of controls involves observing the cash handling process. Auditors may witness cash receipts and disbursements to ensure that established procedures are being followed. This includes verifying that cash is counted accurately, recorded promptly, and deposited in the bank without delay. Another test is the examination of bank reconciliations. Auditors review the reconciliation process to ensure that it is conducted regularly and that discrepancies are resolved in a timely manner. They also verify that reconciliations are reviewed by independent personnel to prevent unauthorized adjustments. Auditors may also test the adequacy of segregation of duties by reviewing the roles and responsibilities of employees involved in cash transactions. This involves ensuring that tasks such as cash handling, recording, and reconciliation are assigned to different individuals to reduce the risk of fraud. Finally, auditors assess the documentation and record-keeping practices related to cash transactions. They verify that all transactions are supported by adequate documentation and that records are properly maintained. This helps ensure that the financial records are complete, accurate, and reliable. By testing controls, auditors can identify weaknesses and provide recommendations for improvement. This not only enhances the organization's control environment, but also contributes to more accurate financial reporting. Section 9. Substantive procedures, detailed examination of cash. Substantive procedures in auditing cash accounts involve direct examination of the organization's cash-related transactions and balances. These procedures are designed to provide audit evidence regarding the completeness, accuracy, and validity of cash accounts in the financial statements. One substantive procedure involves confirming cash balances with external parties such as banks. Auditors send confirmation requests to financial institutions to verify the accuracy of reported cash balances. This independent verification provides assurance that the cash balances are free from material misstatement. Auditors also perform detailed examination of cash transactions by vouching. This involves tracing transactions from the financial records to supporting documentation such as bank statements or receipts. By doing so, auditors can confirm the authenticity and accuracy of recorded transactions. Another substantive procedure is the analysis of cash disbursements. Auditors examine a sample of cash payments to ensure that they are authorized, properly recorded, and supported by valid documentation. This helps identify any unauthorized or improper disbursements that could impact financial accuracy. Finally, auditors perform analytical reviews of cash flow statements. By evaluating cash inflows and outflows, auditors can assess whether the cash position aligns with the organization's operational activities and financial condition. Discrepancies may indicate misstatements or financial issues that require further investigation. Through substantive procedures, auditors gather sufficient and appropriate evidence to support their audit opinion on the cash accounts. This ensures that the financial statements are presented fairly and accurately, providing stakeholders with confidence in the organization's financial reporting. Section 10. Marketable securities types, risks, and audit approach. Marketable securities as part of cash management represent short-term investments that are easily convertible into cash. These securities include stocks, bonds, and treasury bills, which are held for trading or temporary cash surplus management. Auditing marketable securities involves understanding the unique risks and applying specific audit approaches to ensure their proper valuation and disclosure. One risk associated with marketable securities is valuation risk. The fair value of these securities can fluctuate significantly due to market conditions, affecting the accuracy of reported figures. Auditors must assess whether the valuation methods used by the organization comply with accounting standards and reflect current market conditions. Another risk is the misclassification of marketable securities. Companies may incorrectly categorize long-term investments as marketable securities to present a more favorable liquidity position. Auditors must verify the classification of these investments to ensure they are reported correctly based on their intended use and maturity. The auditor's approach includes confirming the existence and ownership of marketable securities with external parties, such as custodians or brokers. This confirmation provides assurance that the securities are genuinely held by the organization and are available for conversion to cash. Auditors also evaluate the disclosure of marketable securities in the financial statements. This includes reviewing the presentation of these securities in accordance with applicable accounting standards and ensuring that all relevant information, such as risks and fair value measurements, is adequately disclosed. In conclusion, auditing marketable securities requires a thorough understanding of their characteristics and associated risks. By applying targeted audit procedures, auditors ensure that these assets are accurately valued and disclosed, contributing to the transparency and reliability of financial reporting. Section 11. Decision-making, applying professional and ethical frameworks. Auditing cash accounts demands adherence to professional and ethical standards to maintain the integrity and objectivity of the audit process. Auditors must apply decision-making frameworks that guide their conduct and ensure that their work meets the highest ethical standards. One key aspect of ethical decision-making is independence. Auditors must remain free from conflicts of interest that could compromise their impartiality. This involves avoiding financial ties or personal relationships with the audited organization that could influence audit judgments. Professional skepticism is another critical element. Auditors must approach their work with a questioning mindset, critically assessing evidence and questioning the validity of management representations. This vigilance is essential in detecting potential misstatements or fraud. Confidentiality is also important in ethical auditing. Auditors must protect sensitive information obtained during the audit and refrain from disclosing it without proper authority. This ensures that the organization's privacy is respected and that audit findings are not misused. Finally, auditors must comply with relevant laws and regulations governing audit practices. This includes adhering to accounting standards, audit guidelines, and professional codes of conduct. By doing so, auditors demonstrate their commitment to ethical excellence and contribute to the credibility of the audit profession. In summary, applying professional and ethical frameworks is crucial in auditing cash accounts. It ensures that auditors conduct their work with integrity, objectivity, and professionalism, ultimately enhancing the quality and trustworthiness of the audit process. Section 12, Conclusion, summarizing the audit of cash accounts. Auditing cash accounts is a vital aspect of ensuring accurate financial reporting and safeguarding a company's financial integrity. Throughout the audit process, auditors must address various risks, including inherent fraud and control risks, to provide assurance on the reliability of financial statements. Significant accounts related to cash require careful examination to ensure proper valuation, classification, and disclosure. By employing preliminary analytical procedures, auditors can identify potential issues early in the process, allowing for targeted and effective audit strategies. Responding to identified risks involves enhancing audit procedures, improving internal controls, and maintaining open communication with management. These actions help mitigate risks and enhance the accuracy and reliability of financial reporting. Substantive procedures and tests of controls play a crucial role in gathering audit evidence and assessing the effectiveness of internal controls. These procedures provide the foundation for auditors to form their opinions on the financial statements. Furthermore, auditing marketable securities involves understanding their unique risks and ensuring accurate valuation and disclosure. By applying professional and ethical frameworks, auditors maintain the integrity and objectivity necessary to conduct high-quality audits. In conclusion, mastering cash account audits requires a comprehensive understanding of risks, controls, and strategies. By following a systematic audit approach, auditors can provide valuable insights and assurance, contributing to the transparency and reliability of financial reporting.